Hi Forex Traders, you're welcome back. This is Charis Trading Institute, and in today's episode I want us to take a review of last week's action, and as I quickly also take an analysis of what I'm anticipating in the coming week and how I'm going to position myself for the trade opportunities that will unfold itself during the week and in the coming weeks in this month and going into the next month. Okay, so if you are on this live session and you can hear me, I'd like you to drop a comment in the comment section and let me know that you are hearing me. Just drop a comment in the comment section. Let me know that yes, you're hearing me and you're ready for what we're about to do today, right? Let me know that you're ready for what we're about to do today. We're not going to take much time, but it's going to be very interesting. It's going to be very interesting. Just drop a comment in the comment section. Let me know you are with me before I start to dish out the informations. Alright guys, sorry, I'm sharing the links with some of the communities online, so if you have communities you would like to share the link with, you can as well just share the links with your communities. Trying to share the link with my Facebook community, Charis Trading Institute, and my Telegram community as well, Charis Trading Institute. If you are not yet in the community, you can just check the link in the description of the video and you're going to be redirected to the Telegram community, where I usually get to upload trade opportunities and what I'm looking at, and also other opportunities, okay, of the trading industry. So you can join, it's going to be beneficial to you, I'm sure. Alright guys, without wasting our time, I think it's good we get started right now. So this is the dollar index monthly chart, and as usual I like to start my analysis from the higher time frame, just to know the higher time frame institutional order flow, so that I trade in sync with what the higher time frame is predisposing. All right, so I like to go to the higher time frames, especially the weekly or sometimes the monthly, weekly and daily time frame, so that I get in sync with what the institutions are doing, because the institutions usually position themselves on the higher time frames. Okay, so today's analysis is going to be very interesting, because you just saw something very interesting that I would like to bring to our notice. It's called the seasonal tendencies. Those of you who are ardent followers of Michael Hudson, the founder of ICT, you would agree with me that there's something he mentioned which is very true. Seasonal tendencies, okay, of an asset class or a given currency pair that you love to trade. So currently we are in a bearish seasonal tendency for the dollar, okay, looking to see the dollar form a low around mid-April and going into June. That's when we're anticipating to start to see a bullishness on the dollar index. All right, and we already understand basic correlation between the dollar index, which is our benchmark assets and foreign currencies, which are our underlying assets. The basic principle of the correlation between the dollar index and foreign currencies is such that if the dollar is positive, by implication if the dollar is bullish, we would like to see bearishness on foreign currencies, across foreign currencies. All right, the euro USD, the AUD USD, GBP USD, NZD USD. Okay, all of these pairs or dollar associated pairs or currencies that have the dollar as their code currency, okay, the relationship between that type of currency and the dollar is opposite. Okay, if the dollar is bullish, we like to see bearishness on foreign currencies. If the dollar is bearish, we like to see bullishness on foreign currencies. That is why you started to see some level of bullish bias on the foreign currencies, the GBP USD, the Euro USD. You are already beginning to see that rise. Yes, there's why this is happening, because price is not just random. There's a specific reason why price has to move from one institutional reference point to the other. Okay, there's a specific reason why price moves the way it does. All right, fortunate enough, if you are still struggling to understand institutional reference points, okay, there are two things you can do. It's either you go through the videos on this YouTube channel so you learn them for free, or those of you who are not good with reading, you need to have a document, a book. You can also get a copy of my book, Institutional Trading. I've taken out time to explain institutional reference points as a topic in that book, and it clearly explains why price moves the way it does from one institutional reference point to the other, and how to outline this institutional reference point correctly. All right, that's just by the way. So going into the weekly time frame, the 1 week chart, and studying in hindsight, you could see that price gave us a displacement around October to the downside. Price created a displacement, right, creating or engineering a shifting market structure to the downside, which we saw around here. When the body of the candle closed below that low, that was when the true shift of market structure happened, right? Thereby creating a weekly bearish order block as well. We saw a failure swing here. Price created a failure swing, showing that there is a decrease in buy pressure. Then it led to a shifting market structure by this displacement candle to the downside, creating an imbalance or sell side imbalance, buy side inefficiency, and price traded into institutional order flow entry drill. Right, there's a criteria that there is what makes this an institutional order flow entry drill. So price tapped into institutional order flow entry drill, okay, with institutions pairing up their short orders with the previous long orders. Okay, this was the last time price went to the downside. Previous shorts, before we started to see a buy, they went into that candle, 50% of the wick of this candle. That's where the institutions traded into, paired up this very candle with the wick of this candle. Okay, this confluence with an institutional order flow entry drill, and we saw that displacement to the downside. All right, so currently we see price reacting off an implied fair value gap of the weekly time frame. Price created a swing low inside that fair value gap, which is in a discount of the entire weekly range or the monthly range we outlined. Between this low to that high, price traded into just below 50% of this entire range. All right, which creates which makes it a discount, because we said when you outline a trading range using your Fibonacci levels, and price trades below 50% of that Fibonacci level, that is usually a discount. Once price trades above 50% of that level, that is premium, and a simple logic is to sell at premiums and buy at discounts. Sell what? Premiums, you buy the discount. So this is the monthly time frame from the low to the high. Price traded below 50% of that this entire range, and confluence with a buy side imbalance and a sell side inefficiency on the monthly time frame, which is further refined to that weekly time frame specific fair value gap. Okay, the weekly time frame specific fair value gap. So we now started to see price trade bullishly into that implied fair value gap on the weekly time frame. So what is an implied fair value gap? This is how it looks like. I think I taught it in one of the videos as well. You can see this area where the last expansion, or this last expansion, was engineered from this bearish order block. This is a bearish order block that has an implied fair value gap attached to it, and remember, the most valid order block is the order block that has a fair value gap attached to it. But in this case, this is a specific type of fair value gap. It's not even popular anywhere until the founder of ICT Concept decided to teach it out, and it makes sense because this is interesting. All right, so in cases where you see an efficient price delivery, remember, a fair value gap is usually a 3-candle price pattern, with the first or the wick of the first candle not matching up with the wick of the third candle. Then that's a typical fair value gap. With this type of gap is when you have an efficient price delivery. This time around, it's not a gap in between the wicks, but rather when you have an efficient price delivery, then you measure 50% of the wick of the first candle and 50% of the wick of the third candle. That in itself is an imbalance in between, and is called an implied fair value gap. All right, that's where price traded into, started to trade to the downside. All right, so where is it heading to? We're trying to confluence this with seasonal tendencies. The seasonal tendency says that we should expect to see the dollar forms a low around mid-April and going into June. Yes, that's what the seasonal tendency chart says currently. All right, you can go to barchart.com and find seasonal tendencies chart and try to study it so you can clearly understand what I'm trying to explain. Okay, in mid-April, we are expecting to see the dollar form a low before it starts to rally. Okay, so currently I think this is where we are on the weekly time frame. We are in a bearish order flow because in the last 3 weeks, price has been clearing out the previous weekly lows. Okay, price manipulated and took out buy side liquidity residing above relative equal highs here, or equal highs here, an old high here, traded into that implied fair value gap. Then price took out the low, previous weekly low. Then last week, we had a bearish close. Price took out the low of the previous week as well. This is a bearish order flow. Where is price likely going to trade into? I'm looking at 50% of this entire candle, which is going to be the bullish order block mean threshold, which is one of it. Then I'm looking at this fair value gap right here. Okay, that should be traded into a fair value gap right here, that should be traded into. All right, I'm looking at price trading into this level on the weekly time frame. Then on the daily time frame, let's see if this gives us something reasonable. All right, so on the weekly time frame, last week, look at what happened. Price traded into that implied fair value gap, which also confluenced with the daily time frame volume imbalance, as we previously outlined in the previous live sessions we had. I already outlined that level as a possible draw on liquidity, and price took out buy side liquidity here, traded into that volume imbalance and created a displacement to the downside that led to a shift in market structure. Okay, we currently are in a bearish order flow. Then price retraced into this level we outlined last week during our weekly analysis. We already outlined that there is a possibility for the dollar to trade into this sell side imbalance, buy side inefficiency that was created during this displacement to the downside. Again, price traded into what level? The bullish order block here. So you can see how specific institutional reference points are. Price is not random. Price traded into a bullish order block here by the left. It has a fair value gap attached to it, and price traded or repriced into premium institutional reference point. What do I mean by premium? If you use your Fibonacci between that high to the low here, okay, price traded above 50% of this recently created range, and above that 50% we are looking at an institutional reference point, and there was a fair value gap. So price institutions reprice the dollar into that level, and the dollar is heading for what levels? Heading for sell side liquidity residing below this relative equal lows or old low right here. I'm looking to see the dollar trade into that level. All right, sell side liquidity, sell side liquidity right here, residing below that level, that old low, because we said liquidity resides in two forms, either above or below marketplace. If liquidity resides above an old high or relative equal highs, it is called buy side liquidity, and that kind of liquidity is because there are buy stops residing above that high or relative equal highs that the institutions would like to pick up their orders before they start to distribute to the downside. And if liquidity resides below an old low or relative equal lows, there is sell side liquidity residing below that level, and the institutions will usually like to trade into them. So we are looking at this sell side liquidity, and what again? We are looking at that fair value gap, or you can call it because, and another reason is because there is a sell side liquidity also residing below this old low here. Let me clearly outline them. The old low here is liquidity. It's liquidity. There are liquidity residing right below that level. All right. Then we can see on the daily time frame, what do we have? Price accumulated here, took out the relative equal lows, manipulation or Judas swing, and we see the distribution to the downside. All right, this is clearly market maker buy model that unfolded. I'm looking to see the dollar trade into this bullish order block as well. This bullish